Brian Lenny is the editor of the Junior Stock Review, where he discusses the current mineral cycles and investment opportunities in the junior mineral resource space. I'm Martin Gagel with Market Radius Research. Please remember that this video is neither a recommendation nor investment advice. We're here to learn about the company. Brian, welcome and thank you for joining us today.
Oh, thank you for having me, Martin.
All right, all right. I really appreciate you doing this interview. This is, I don't know, it feels like a bit of all cycles or these upswings in the cycles feel a little crazy and hectic. And I'm hoping through this discussion to tease it out, what some aspects of it, some ideas, how to play the market in this whole thing. But what I think your backstory is quite interesting. It sounds very exciting and a lot of fun. And I was impressed with people who go on their own to follow their dreams. So, how did you get into this mineral resource, the junior resource space?
So I think it's best to I'm an engineer by trade. I started at a school into steel manufacturing, and I worked in that
So,
for
sorry, just to cut in, not a mining engineer or nothing
no
to do with the resource sector. Like,
no.
okay,
Well, it's there's play in because steel manufacturing, iron ore, like from the raw materials side, there is a tie in, and the
yeah.
metallurgy and how things are processed are somewhat similar. But you're right, you're definitely not a mining engineer. I'm a mechanical engineer, and I worked as a process engineer for this steel company, and I did that on the floor for the first 4 or 5 years of the 10 that I was there. And then I took a so-called promotion into management, which was quite different, moving from a technical role to very much a people role. And I was, I had a number of people underneath me from the hourly group and from the management side of things. And it was a good promotion in some ways and terrible in another. I quite enjoyed the technical side. I enjoyed the relationship with the guys. But as soon as I sort of took that differential into a higher up position, that relationship changed, and I wasn't enjoying what I was doing. And with a young family, my days were spent arguing, and I would get home later, leave early, and I wasn't spending the time or being in the right mood, for those kids and for my wife. And so I was looking for something different. And I had started or had caught on to the resource sector via guys like Doug Casey, Rick Rule. I'm a libertarian, and that philosophy really resonated with me. And I started going down the the pathway of monetary policy, getting into bullion. And then invariably, I think when you sort of go down that path, you somehow come across the junior resource companies. And so I had these two things happening. I had my career, which had taken, while I was going well, it had taken to a turn that I wasn't, mentally enjoying it. And I started getting really interested in these junior mining stocks. And probably one of the biggest mistakes that happened is the first junior I invested in, I doubled my money. And I
Oh, that's the worst. It is. You learn all the wrong lessons from that.
Yeah, and I somehow thought it had something to do with me. And so I went through a few years of learning, but by 2013, I sort of, or at least felt like I had a good handle on the market. And with feeling the way I did about my job, is like I need a way to escape. And I thought, if I can make enough money, especially in doing something like this, that's the way to do it. So in 2013, the market had come off its high in 2011, and I thought, oh, you know what, I got to take a huge jump here. And I took a lot of risk in terms of I sold my house. And I took two-thirds of the equity and I put it into a handful of what I thought were the would be the best performing juniors. And it's just so happened they were. I had to wait 3 years. So if it was, yeah, I first started deploying money in 2013. By 2014, I'd basically deployed all the money and sort of sat there for 2 years, watched my portfolio drift down by, I think it was about like a minus 36, 35%. I was still making good money, so it wasn't that terrible, but it was still quite, um, it was nerve-wracking in a way to see your portfolio go down that way and think that you might be wrong. But in 2016, the market turned. I've got a completely supportive and understanding wife, and so I left that career in steel manufacturing to pursue investing.
Oh, so until this point, while you sold your house, you had an income, a check
Yeah.
coming in.
Oh yeah,
Okay.
yeah. Yeah, yeah. No, that's yeah, I think if it would have been crazy if I would have done it the other way.
Yeah.
This way, like I still had a third of the cash that I had from the house sale, and I had a steady paycheck, a very good steady paycheck at the time. And so, there was stuff to fall back on, and I don't want to paint the picture like, that it was this like, and it was risky, but that it was completely like I had sort of a fallback plan if things didn't work out, and I'm super glad that they actually did. And so 2016, the portfolio went up like close to around 300%. I ended up being in a handful of those like best performers in 2016. And when I was leaving steel manufacturing, I was forced to take that money out of the market, which again was a serendipitous thing to have happened because I probably would have just sat on it otherwise at that point in my investing career, to buy another house, to move, and to sort of have a cushion of cash to support the family. So, and then that's sort of how I got started, 2016, and I've been independent investor in the sector ever since. And I started the newsletter in 2020, and yeah, it's been a wild ride over the last 9 years.
So I'm curious, when you first started deploying, or let's see, when you were fully deployed or largely deployed, how many positions did you have at that point? Like, did you have 10 positions of 10% each, or 20 positions of 5%, or did you go like kind of a barbell, do like a huge 20% swing on a couple of names? How did you build up that portfolio?
Quite honestly, I don't remember the exact details on the portfolio construction because it wasn't that at top of mind. It's something that I've honestly had to learn through mentorship and through experience on how to structure a portfolio properly. And it was really a shotgun approach, is to be quite honest with you. And what ideas sort of resonated the most at the time, and that's probably what I had the most money in. But what happened is, when you have major changes in sentiment in the market, especially after 2011 high, and then you go to 2016, that 5 year period where the world kept on printing money, interest rates were still super low. There was this major sentiment change, and so you had across the board. Like I had a couple 10 baggers, like Reservoir Minerals, that really paid, for my house. Like those things where yeah, it wasn't necessarily the bulk of my portfolio, but when you go 10x or 8x or 7x, like they become a bigger part. And
Yeah.
like I said, I was actually forced to sell because I needed to go out there and I needed to buy these certain things to set myself and my family up. And again, like how I've set up a portfolio now is totally different from back then. And right now, it's very strategic in the way I set things up. I'm more apt to invest in what I would call like a highly probable double and put 10% of my portfolio in it versus a 2% expiration roll of the dice that can go 10x. Both can achieve a 20% weighting in your portfolio, but one does it very differently from the other. And I like the high probable ways of making money. I want to reduce risk wherever I can, and I want to play to my strengths. And that puts me into junior mining companies that typically have a resource, something I can put numbers to, figure out the price to value ratio, or what the delta is between price to value, and invest accordingly, and be able to identify those catalysts that the market's going to recognize to close that differential. And I've done really well with it. And that is something that was learned. That isn't something that was like just naturally came to me. That's something that's taken 10 years to sort of get to. And I'm a firm believer in, I don't know if you've ever heard of the 10,000 hours. I forget which writer wrote the book, but he said you need
Malcolm Gladwell
Malcolm Gladwell.
popularized it. Yeah.
Yeah, like it just makes so much sense to me. And the quicker you can
Yeah.
get to that 10,000 hours in whatever profession or skill you're trying to hone, the quicker you're going to get to, the best performance that you can. And I would say again, being able to focus on this for the last 9 years, to have the input of some mentors has really fast forwarded me to that point where I operate true to myself, and I've had the performance or the profits to kind of back it up.
So you mentioned that your tendency is to put uh wait for the companies to be de-risked with a resource estimate, and then a larger bet or a weight on your investment at that time. Can you flesh out what your investment strategy is, and at
Sure.
what points maybe will you not break it, but I presume you maybe have a portion of your portfolio which you'll put your 1 or 2 percenters with
Yep.
explosive returns in, and just talk about that whole investment, your portfolio, how you structure your portfolios.
Sure. So like I said, like I'm an engineer. I may not be a mining engineer, but I've got a very analytical brain. And so I like to put numbers to stuff. It helps me understand it. It also helps me put in perspective of what the upside potential is and most importantly, what my downside protection needs to be for me to become an investor. And that's what's kind of slanted me to like what you said, the more de-risked companies out there. I'm a bottom-up investor, which means that I focus on the companies first. And timing does matter. The cycle matters when you buy these companies. Like obviously, if you can buy a company before the bull cycle and hold it into the bull cycle, that is when you're going to maximize your return. But my priority is to find good companies. And so the resource, again, that's something I can put numbers to. I can take that resource, put it in a discount cash flow model, and sort of come up with an after-tax NPV, and that would be the value in the company. And then the price is whatever their market cap is, what they're selling for. And then for certain companies, depending on what the commodity is, depending on who the people are, the percentage or the differential has to be within a certain range for me to become an investor. Like I said, like I want to protect my downside, and that's what's going to make up the bulk of the portfolio. And it's worked exceptionally well. On the other side, especially when you're dealing with bear markets and you're dealing with expiration, like I said, that it wouldn't be my strong suit. I do understand it to a point, but I want to invest in people that I know. And so if you look at my portfolio, you look at the exploration companies that I'm involved in, typically what you're going to see on the exploration side is I'm going to have a heavy weighting towards prospect generation companies, but very specific ones. I like the idea of the prospect generator business model. I don't think it's a
And sorry, on the prospect generated, this is on the smaller weight, higher risk return part of it, or just in your general a typical investment for you?
Well, I would definitely put it like any sort of exploration is I would deem on the higher risk side of things. Like
For
if you have
sure.
a spectrum, it's on the higher risk. But I would say the prospect generator, what it does is it de-risks to a point the downside. And
Yeah.
that's something that I really focus on is trying to protect my downside. So I try to invest in good people that have, high geological acumen, and they're putting that to work in terms of creating projects and then JVing them to bigger companies that pay for the majority of the exploration work, and they take the majority of the success if they're successful in the project, right? It's usually like 80-20, 70-30 in terms of ownership for that certain project. And then they go from there. But I look for specific things. Like I don't think they're a ubiquitous buy. I think there's a lot of prospect generators out there that sort of they're almost like lifestyle companies in that, yeah, they've got a bunch of projects that are JV'd with senior mining companies or mid tiers or other juniors, but they just perpetually are stuck in this mode where nothing really happens. And so there's specific things that I want to look for, and success or a very strong, followable way of deploying their technical acumen. Like I'll use an example, Kenorland Minerals, and highly biased here because they're my biggest position. Kenorland is led by Zach Flood. They've got a defined
Sorry, what's the ticker on that one?
KLD.
Okay.
They've got a defined process of looking for mineral deposits undercover, and they do the same process with every single projects that they stake. They go for large land positions, plus 10,000 hectares. They want to find these plots of land in areas near large deposits that haven't been drilled. So this is virgin land. They're looking for stuff undercover. So whether that's glacial cover, soil cover, whatever. They do regional scale till sampling. And from that, they narrow down it. Well, so first they'll narrow it down into more localized stuff if they find something, and if they don't, they just get rid of it. But then once they do that, they're able to take that project and go to a handful of some of the best senior mining companies and do a deal with them on like 80/20, take a royalty back, and then get these things in motion in terms of a spend. And so to me, they have a very definable way of how they work through their process, and that's what I want to invest in. And so if you look again, those prospect generation companies that I invest in have those certain criteria, big projects, big ideas, and they've got access to the senior mining companies. And I would say the top handful of prospect generators really stand out from the others. And then after that, again, I'm not you're not going to see me invest really in a grassroots exploration, like something that has no drill holes or anything like that, plainly. Again, I want to see a number of drill holes, or I want to see something that gives me understanding of what might be ahead. And then first and foremost, I need to know the people. And if I don't have a relationship with the people, there's no way. But those like advanced explorers that aren't prospect generators, I need a good relationship with the people. They need access to cash, and they need really good results from whatever I see. So, and then again, you'll see them occupy a much smaller percentage of my portfolio, and they're the real speculative side. All of this, any junior mining is speculative. These companies are really floating abstractions, but the exploration is very much so on the very high risk end of things. And that sort of portfolio mix is really what's made me consistently successful, and it's true to me. And I think that's the most important thing for any investor. You're like, the way that I deploy money isn't necessarily going to be the way that Martin deploys money, and it shouldn't be, because you've got your own skill set, you've got your own way of looking at the market, and you're going to construct your portfolio a little bit different. And I think in listening to people talk about this, the biggest takeaway I would want to give to people or investors is to just be introspective on what your risk criteria is, what your knowledge level is, and sort of use that as how you're going to deploy money. Because the more true you can be to yourself, the I think the more success you're going to have. And you're going to be focused in the right areas. The exploration is so sexy, but there's only a certain segment of us out there that can really truly do that properly. So I don't want people to lose money in this bull market. There's too much opportunity on the upside with some of the less risky stuff.
Well, I always view mineral exploration as really an application of statistics. And the good explorers and prospectors, they try to raise their probabilities by going to the higher probability lands. You don't pay too much for it. And then you start punching in holes, and until you start digging the mine out, you never actually know what's underneath there. You take, they call them samples for a reason. You just take the sample and okay, we got gold here, we got gold here. There should be gold in the middle, but sometimes there's not. So
Mm.
it's and that's where I think a lot of it is like poker playing. You never know for sure. There are bets. You got to right size the bets, and you can't go all in because, well, you hear about some people who go all in and get lucky and win the whole thing, and then other guys, the majority of them, they go all in and get wiped out, and then when you get wiped out, it's really hard to build that back up. So
Completely, completely.
yeah,
And like I think too often that especially in the bear portions of the cycle, people end up taking more risk than they should, and they miss the markets that we're in today. And if you can
yeah,
just hold on to and make sure you don't blow yourself out till you hit
yeah,
a bull portion, and you can keep your head about yourself and actually sell when you have profits, and
yeah.
get past the greed, then you can actually make money. Because I think far too often I see people blow themselves up. They get super upset with the companies, and I think that's not totally unfounded. I think there's a lot of bad companies out there and a lot
Yes.
of bad people that rightly you should be upset with. But ultimately, to me anyways, it comes down to you, and like you are responsible for how you deploy money, and you have to keep in mind that some people don't have your best interests in at heart, and you have to be able to figure out who those management teams are and who they are and who they aren't. And ultimately, it comes down to you. But just don't blow yourself up so you can actually experience this bull market, because it changed my life. And like I truly believe that it can change other people's if done correctly. And it takes some time, or it takes some also probably some guidance. Like I wouldn't be where I am today without mentorship. The people that I've looked up to for a long time, and in a couple cases, these people became, very good friends of mine. I wouldn't be where I am today if I hadn't learned those lessons with them, and continually need to have conversations with them about how I'm seeing the market, how I think money should be deployed. So there's something to be said about the learning curve, and I don't think you ever stop learning. There's always something that comes, especially in this sort of sector that's got so many segments. Like if you look as a resource sector investor, like really you got to be good in you got to be able to look at a balance sheet. You need to have some geological understanding. You should be able to have not necessarily an engineering background, but some sort of analytical ability to put numbers together in terms of trying to figure out what something is worth, what the value is. Like one of the biggest reasons why people can't sell is because they don't know what something is worth. So when the price goes up, they have no idea whether it should go up another 30%, or whether they should be selling now, or whether the thing is way overvalued and they should have sold, well, you take advantage of that overvaluation, but they probably should have sold, 2 weeks ago. So like be able to understand the value of something is so very important. And when you look at those aspects of what you should be trying to learn as an investor, there's multiple pillars that go into being a good junior resource sector investor, and it does take time. Like I said, like that 10,000 hours, I think to be proficient in anything, you sort of need to get close to that.
Yeah. Well, one thing I wanted to, I guess, elaborate on when you like, oh, it's the value, it should sell it now. I think especially if you don't have a good sense of value, and in a bull market thing, everything can get overvalued, and people sort of use this paradigm of speaking, oh, should I sell or should I hold? It's like, well, if you're not sure, sell a little bit. Like take a little money off the table. It's not a binary thing. You got thousands of shares. Take a little bit off, take a little more off, and you're never gonna hit the top. There's a much better chance you'll hit the bottom selling than you'll hit the top selling.
Totally.
And
Totally.
so yeah, so take a little money off the table. You never win the whole thing. Anyways, my two bits on that. I'll give that is investment advice for viewers out there. They're at
Well,
selling your house. That's not investment advice, but
well, no, but
taking a
you're
little money off the table is investment advice.
But that's being introspective. Like what you
Yes.
said is to a T. It's like, oh, you say, I have no idea what this thing is worth. It's gone up, and you're bang on. It's like the more you're honest with yourself, and the more you ask that question, and if you can't answer it, you need to come up with like with a set. Like I'm telling you, like the first, and I still operate this way, but I was more so early on. Like I had a piece of paper beside my desk, like literally at the right side beside my mouse, and it had a set of rules. And it was basically like, this is when I sell, this is when I do this, this is when I don't do this. And every time I was going to make a decision, I would look at that list and make sure I'm staying true to it. And now, it's more fluid, like it's just in me. Um, but I would highly suggest that people do that. Have that piece of paper, set rules. Like the less that you know, the more you need that piece of paper there to remind you, hey, look, like on a double, I need to sell half. When I do that, there's no risk to me. I just may not make the profit that I wanted to. And that's an amazing place to be in. And yes, you might take away from your upside, and people will talk about, having to ride your winners and blah, blah, blah. But I'm telling you, for the vast majority of people, you need that set of rules. You need a way to operate and sort of take the emotion and all the other junk that can sort of be bombarded, in these moments when momentum is so high and the juices are flowing, because emotion becomes such an overpowering thing. And that's for everybody. We're all human,
Oh yeah.
maybe varying degrees, but we're all susceptible to it. So yeah, I think it's very wise advice.
Um, you mentioned with like prospect generators, and I just want to build this out to a bigger concept, and I guess it fits in with your comments on lifestyle companies. Knowing when like a management team like the sign of a good management team, or one of the things that they do is they'll take a project to as far as they think it can go. And at some point you may have to like, oh, we're not this isn't really economically viable, or it's too small of a project, what we want. We need to spin it out and do something else with it, or just kill it and then focus on more prospective projects. And that's where I think a lot of like sort of the bad management teams call it, they'll just stick with a project and turn it into a lifestyle, or maybe they've just fallen in love with it and they think there's something there, but they just grind away at it for like in the venture markets. There's some guys who've been grinding away at the same projects for over a decade, and they haven't really gone anywhere
Yeah.
on it. And whether it's a lifestyle or just what it is. Anyways, any thoughts on advice on older projects, how to assess those in terms of, hey, maybe like they've got a resource estimate, but it's been getting a little aged here, not really much is going on. How to assess when a project is maybe stale dated and you shouldn't be looking at it anymore?
Sure. So, like, I guess I'll give it in two different answers. I'll say first on the exploration side, if this is something that has no resource, but it's got drill holes in it, you need to look at what those historical results are and see, usually these things fall apart because of continuity. That's a big thing. If you can't see consistent grades and somewhat consistent widths, depending on how many drill results you see, this can be part of the problem. And I like those sorts of projects. Like I said, I stay away from anyway. So that's not really a situation that I come across a lot myself because I usually avoid it anyways. On the other side, when you have a resource, and like you said, you have this project with a company that's has been at the resource stage or PEA typically, and it's been there for a decade. Usually, the proof is in the pudding. Meaning, once you put some numbers to that, you see what the after tax net present value is at a respect. You need to use a real discount rate. Like you have to, I would say you have to use at least 10%. Like this 5% is marketing, and people just have to get used to that. Uh,
Yeah,
but you want to see what that differential is, and then
yeah,
use somewhat of a conservative metal price. If you, let's say today you have $4,000 gold. Well, I would say that if you use $3,000 gold, that's probably a good value to use. And again, if you don't see tremendous economics at $3,000 gold, the answer is that the project that you're looking at is highly marginal to the low side, and it needs these, absorbent gold prices for it to be economic. So, on that spectrum, it's going to be on that bottom half. And again, for like a major mining company is probably not going to be looking at it unless there's some like proximity game that just makes sense. And like you need to be able to tie it in there somehow if you're going to think about M&A. But typically these low end projects are the ones you've seen that have been around for many years, probably won't be developed, even though we're going into this what I think are going to be higher gold prices in the future. Again, these are going to be on the lower end of the projects that are going to be developed further, and usually they're huge capex, and there's a number of aspects that are going to play against these guys. But usually, like I said, the proof is in the pudding. The numbers will tell you exactly what you're dealing with, and typically the best projects you're just not going to see around for multiple decades or multiple cycles because they're good, and so that's what you can look at as an investor. And typically that's not good unless you're talking about a management team that's doing something completely different with it. And I don't even know what that might be because I've seen it in a whole bunch of different scenarios where they've got some other idea about, consolidating a region in this they picked up this project because it fits into like a piece in a bigger puzzle. You got to listen to that story and see if it makes sense. But again, the numbers are going to tell you exactly what you're dealing with. And again, a balance sheet will tell you most of the time how a company is being run. When you see G&A exceed 15 or 20% of expenditure for a company that seemingly goes nowhere, you can see that that company is just there to keep up the lifestyle, that management team. And again, those prospect generators, there's a few at least that I've seen that could probably be classified as lifestyle companies, considering they've been around for so long and nothing really seemingly changes. And that's not a good state to be in. The best companies have a continual pipeline of new projects coming in and new JV deals. There's always new stuff happening, and those are the management teams that are actually trying to do something, create value, and that's who you want to stick with. Yeah.
So I was, as you were talking there, I was thinking about your investment strategy in the junior resource versus mine. I am not nearly as well. I'm reasonably knowledgeable, but not nearly as knowledgeable as you. And for me, when I look at the more advanced projects where their resource estimates are looking towards, okay, can we develop it? You're talking about how are there consistent widths and grades and so forth on it. For me, that's like, and then you get into metallurgy and you're really trying to weight whether this resource can turn into a project, can turn into a mine. And I don't really have this, I don't have the skill set for it. And the amount of time it would take me to sort of figure out the whole thing, I'm not, I'm a generalist investor, so I'm doing biotechs and other stuff as well. So I actually invest in the earlier stage ones where it's like 5 meters at 20% grams per ton. Like that's just people aren't worrying about the next steps at that point. They're just like, oh,
Right.
are there sexy numbers? That's going to drive it up. So that's where because given my knowledge where I'm able and willing to put in the time and the effort, I kind of roll the dice on those types of projects, given that's where I feel comfortable with. And no, I don't sell my house and roll the dice on those ones. And that's you get sort of the immediate gratification. It was a big hit. It wasn't a big hit, and then I weight my bets so I don't blow myself up on it. Sometimes I win. I At least in this cycle, it's really easy. I'm more winners than losers there.
Mhm.
But anyways, it's just interesting that and if you really don't know anything about it, maybe then just invest in the majors where
Yeah.
they're developing projects. You think the gold price is going to go higher. They got tens of millions of ounces in the ground, and you're betting on a management team that knows how to work that for you.
Yeah. Well, like the investing in the senior mining companies, if you can read a balance sheet, I think that's probably the number one thing. You talk about, and then even like the other step that's even more or even less risky would be the royalty and streaming. These
Yeah,
companies are exceptionally run. They don't have the so-called they do have risk to mining operation, but it's not the same. Those
yeah,
royalty agreements or those royalties are there through thick and thin. If a mining operation gets stuck because of social problems or whatever, the royalty doesn't go away. The cash flow goes away. But if anybody restarts that mine in 5 or 10 years, then it just restarts. Whereas the mining company is totally susceptible to the operations. And if something happened and they lose that cash flow, that could put them out of business. So like that would be the differential in the risk pyramid there. And you're exactly right. Like if you truly don't know anything and you're just starting or you want to dip your toe, that's where you should obviously start and starting to get the hang of how mining companies work and then work your way down into the junior space, like the sub-billion-dollar market caps, which definitely require more knowledge. Even though I still know, like even myself, what I invested in to start, and I knew nothing. And so most people just jump right in, and
yeah,
that is what it is. And just realize where you stand in terms of your knowledge base and who you're competing against. And that, when you're in a bull market, it maybe doesn't matter as much because a lot of things just go up. But, in my experience, I've had way more years with sideways or downwards markets or bear markets than I have in bulls.
yeah,
And so you have to be able to operate in both, and you can get overconfident in the bull thinking that you understand, and then the bear will teach you very quickly that you may not. And so
yeah,
it's a tough way to learn, but typically, and even myself, there's just some mistakes you have to make to learn from, and you can only
yeah.
listen to people so much, and that's just part of life, I guess.
Yeah. What do you and I want to get to more to the what sectors your view on different sectors and that. But let's say if I think for junior investors, investing in a newsletter of someone who's got a track record and kind of generally steer them in the right way is a good investment. But B, if you're just like, oh, Eric Sprott invested in this deal, I'll follow him there. Oh, Michael Gentile, he cut a check in there. I'll follow that money. Like following, call it the smart money, or this is a juicer deal. Let's throw some money there. And I don't want you. Let's say I'm not trying to get you to maybe, oh, he's a say bad stuff or good stuff about particular ones, but just generally the concept of following quote the smart money. What are your thoughts on that?
Uh, I think probably here's the thing. Smart money is usually wealthy money. And what happens is their exposure to the market and what it means to them if they're wrong is totally different than what it means to you. And it also is different from a timeline perspective. An investment in the bear market for a big contrarian investor to wait 2 or 3 years is nothing. It's almost what is looked for because that's how you buy things at their cheapest. And, my experience, that sentiment change, you can make so much money on sentiment change, and it's the easiest money that you'll make. The rest requires more knowledge and more understanding of what you're dealing with. So you can go ahead and make 300-400%, and then that other 300 or 400% is going to require much more knowledge base. So what I'm trying to say is this: yes, there is something to be said of investing with smart money, but realize that more often than not, they have a totally different perspective on what those investments mean to them than you will. And again, your timeline has to fit what that investment that you're making um, is. So, like, if you're buying a company that's downtrodden, like let's look at the gold market 2 or 3 years ago. If you wanted to be set up best for the move that we just had, you had to have bought in 2022, 2023 and been able to hold. And that's when the best or the smartest money would have deployed. And that's and I'll like self promote, like that's when we were putting the newsletter was positioning into gold and silver and a number of other things. Is we have a 2 3 year time horizon, and that's what's brought such fantastic returns. So on the correlation, just remember that your perspective and that high net worth or that smart money is probably different, and you need to have the same timeline. You need to be comfortable with, how long this is going to take to somewhat come to fruition. And just realize that for a billionaire or for somebody who's got multi-millions, that losing out on a 2 or 3% position in whatever their portfolio is probably almost meaningless. Whereas if you have $10 or $20,000 and you want to invest $3 or $4,000 in the same company as whoever, and lose, that's probably much more meaningful to you than it is to them. So, those are things that you need to sort of keep in mind, because it's not ubiquitous. And like there are some of those guys you name that I would say you don't necessarily want to follow because they've got such a wide range of companies they'll invest in, and it's because they're so rich. And
Yeah.
they can go invest in 100 companies, and then like I said, they can lose on 50% of them, and still come out on top or not even care. And so I just don't think that that's how the most of the market, or maybe the people that are listening to this, I don't think they're in that position. So I think you still have to be introspective. I think you need to understand yourself and maybe the smart money that you're following. See if your values and how you want to invest aligns with how they work. If you listen to Sprott, if you listen to Michael Gentili, Rick Rule, number other Dave Lotan, like super smart guys. Listen to them, listen to how they deploy money, and see if it resonates with how you want to deploy money. And if that broader space or umbrella fits your criteria, then have at her. But it's certainly not without risk. And if you get it wrong, if you invest alongside the wrong people, you might get burnt. And again, those are sometimes lessons you need to learn yourself and not necessarily need Brian Lenny's opinion on. So,
With when you invest, do you have a rule, or do you tend to buy in the open market, or do you wait for private placements where you can clip a warrant on that as well? And not everyone has reasonable or any access to private placements. Can you talk about that dynamic a bit?
yeah, I'm not afraid to buy in the open market whatsoever. And I would say that the majority of the investments I take are in the open market. And and like I'm an accredited investor. I qualify for participating in the financings, and obviously in the position I'm in, typically people want me in the the financing, so I get access to it. But you know, when it comes to financings, like there's some things that aren't great, like the 4 month hold. I think sometimes can be problematic depending on the market you're in. I think the warrants, while they can be on the surface good, I can tell you, out of, let's say that I've participated in 30 financings and collected 30 chances to buy stock or 30 warrant positions, and I've probably benefited from a handful of them. And
Yeah.
that's just the reality of it. So again, as a mentor once told me, and I absolutely adhere to it, is that you don't put money into a financing based on the warrant, because not only because of the unlikelihood of matching the right cycle or the right share price movement in the company, but just because it can be too mesmerizing in terms of maybe disfocusing you off what the underlying value is of the company, and you can just make decisions based off of greed, which is not a way to be successful in this business, because you'll end up aligning yourself or with companies that aren't necessarily very good for you, and typically you won't be able to sell. Greed is a really hard emotion to sort of manage. So I think you have to manage it before you even feel it. But yeah, so for me, buying in the open market has been really good. I buy in tranches. Typically, I'll open with, let's say, a 2 to 5% position, and especially being contrarian, I'm usually investing when things are out of favor. So I usually get a chance to buy the shares at a cheaper price along the way. And the longer I've done this, the more I see that as opportunity, and it's worked exceptionally well for me. So now look, those positions that I'm highly confident in, that I know management, I know the story, I'll go up to 10%. Maybe in some cases have gone a little bit more than 10%, and that's for very specific reasons. But I'll buy that all in tranche, and that's a way to, dollar cost average is like the most common way to look at it, and I think it's a good way for a lot of retail investors to approach it. Now in a bull market, it's different, right? Everything is moving, and we could be in one of those bull markets where you don't get a chance to buy again, and then you have to reevaluate that. But again, if you can hone these sort of principles and be able to hold them in no matter what market you're in, that's the better way to do it. And I would say again, like the gold market is certainly where you want to be right now. If I had to pick one sector, that's where I'd want to be. But trying to find value and trying to buy stuff in tranches and do it the proper way, and make sure you have that differential is exceptionally hard. And that's why, to me, you need to be, you've already needed to be in the gold sector 2 years ago to really position yourself well. And now, like for me, I've taken some profits. I'm moving them into some of those other sectors that aren't moving as quick, that I have the opportunity to really understand the company and buy my position in pieces along the way, especially when I'm buying in the open market, which is not as easy to take a bigger position.
So let's talk about where you think we are in the cycle. Is it one giant cycle we're in, or a bunch of individual ones? There's the gold cycle that's being driven by its own dynamics, and then copper, and then lithium, and so forth. What are the, like you mentioned you're looking for other sectors to invest in right now. Could you flesh that out a bit on
Sure.
what sectors you think have an interesting sort of value opportunity in them?
Sure. Well, so and like in my view, they all sort of flow together. And I think, which, and this is, you can look back in the data, excuse me, most often gold leads the pack. And the reason why it does is because, gold is to me, gold is money. Gold is that insurance against calamity. It's the insurance against loosening financial policy, all these things. And typically, when you have financial policy or monetary policy loosening, so lower interest rates, you have quantitative easing in some sort of fashion where the government is infusing money into various sectors. It's usually associated with times when times are tough, when the economy isn't that great, whether it's due to the economy, due to maybe some military or war that's going on. So the government is flushing money into the economy, and it's creating disconnects. And so what happens is gold reacts to this. The investors see that currency, or let's say the USD, is losing its hold as the reserve currency, or its attractiveness, like its purchasing power is diminishing, and so they go into hard assets, and gold leads the way in sort of that perspective. And so you see the gold price start to move in reflection of all these sort of negatives that are going on. And with that, when you have the governments, especially let's take right now, you have the critical minerals, and the critical minerals or metals are being pushed by not only the green movement, but very much, I would say, by war, or the prospect of war with various countries around the world, West versus East, US versus China, Russia, like however you want to sort of coin this, you have like sort of a rush for these critical metals and minerals, to feed the war engine, to sort of feed the green movement all at the same time. And probably the race for AI is probably the other thing that I wouldn't say that is being missed, but I would say that the AI component of what's going ahead of the narrative is being discounted on how impactful it's going to be. I think AI is one of those things that it's going to dwarf the internet in terms of an impact to humanity, in a good way, and potentially in a bad way, maybe looking further out, but we'll see where that goes. But these things are driving stuff. So what you see is, you see monetary policy loosening, economics loosening, gold moves first to sort of reflect that, and then you have all these base metals that come into play because they feed into the war, and to the probably technological boom that we're seeing on the other side. And the government's flushing money into critical metals projects, and again, more disconnect is happening. But that's where you're gonna see this whole sector rise, and you could sort of pick out mini cycles within. But I still think the general idea is you've got this huge super cycle, again, led by gold, followed by everything else. And they all have their little cycle that's going on. But the grand theme is that metals prices, I think, across the board are going up. The cost of living for each of us is going up. And if you're not exposed to hard assets in some shape or form, whether it's through equities or through actual real things, you're sort of going to be left behind. And so that's the way I see it. And for me, I want to be buying things that are cheap. So I'm typically looking at stuff that's next to come. That's again selling for pennies on the dollar in terms of what the asset value is. And that's what I've always done well with. But if you want to adopt that mentality, you have to have a longer term horizon. It can't be, I want profits by next weekend.
Yeah.
That sort of thing is great in like the midst of a real momentum fed bull market, like we saw in crypto or marijuana, or gold in the last cycle. Like each metal sort of has that time. But those things, you have to be so careful and be able to sell into that momentum rather than trying to take positions and make big money off of it. It's just so dangerous because most people won't know when to sell, or think it's going to constantly go up, and of course it doesn't.
All right. So, what are your thoughts on the lithium market?
I think, honestly, I like everything,
Okay.
but I think
Because
I think
lithium seems like it's bottomed out in the summertime. There was a lot of negative
yeah.
sentiment on it, and obviously there's like a few years ago the perspective on EVs before the new administration was a little more bullish with tax incentives, but generally over the world, lots of EV growth, and it's still such a small nascent market that you're going to have sort of these quick periods of oversupply and undersupply as the market gets balances out.
I think, it's not something I'm invested in.
Okay.
I've had investments in lithium. Like again, I'm agnostic to the metal. Like I just want to
Yeah.
find good companies. I think that you would like whether it's gold, silver, lithium, nickel, you want to stick to especially depending on what your knowledge level is and how plugged in you are. You want to stick to the best of the best. So, like, I
Yeah.
think if you bought Patriot Battery Metals, I think you're going to be a happy investor, along this way, sort of regardless whether lithium goes into a huge boom or not. I would say, the Corvette discovery is something real, and it's in a good jurisdiction and highly likely to be meaningful considering the strategic investments they've taken. I think that, direct lithium extraction, well, it has to be sort of honed to each individual company and their certain mineralization. I think direct lithium extraction really changes stuff in terms of the differential between brines and hard rock. Um, but it's yet to be seen how that's going to sort of level the whole playing field off. You look at the, and this goes for any critical mineral project, but you look at the Western world's avoidance of letting the Chinese or their non-friendlies into investments into uh, to these various projects, even if they're not located inside the Western country. And like Solaris is the perfect example of what I'm trying to get to is, you invest in Solaris. They've got the Warwinson project in Ecuador. Zijin wants to come in and do $100 million, 9.9% position, and it gets blocked by the Canadian government because it's critical minerals. And it's not even located in Canada. It's just the fact that they were domiciled in Canada that had this overreach by the Canadian government. I think it's insane. I think that is a big risk to, let's say, the lithium. Like if you invest in a lithium brine company and they've got an asset in South America, in the Atacama, you have to be really sure that you're sticking to the best of the best so that there's someone other than the Chinese that might buy it. In the last cycle, the Chinese were a huge buyer of lithium projects in the Atacama, in specifically in Argentina. They picked up a lot of projects that a lot of the senior mining companies would have deemed mediocre at best, but they just sucked it all up. Moving forward, that doesn't look like it's going to be available as long as the company's domiciled in Canada. So these are things I would say in lithium, in copper, in like those critical minerals projects. I think again, I'm bullish on all those sectors, but you have to be really sure of how you see this company's or how you see that profit being made. Like, is it just going to be made off discovery holes? Is it going to be made off of the lithium price going up? Is it going to what's the catalyst going to be? Because if it's M&A and it's a mediocre project, you might be in trouble. And so, those are things I think you want to keep in mind. But that's not just a lithium comment. That's across the spectrum. The only thing they don't care about is gold, which is insane. The Chinese are allowed to buy up as many gold projects as they want. But all we're concerned about is copper, which if you look at the world we live in, I can't see how that is the case. But governments aren't very smart. So that's that's the reality of life right now.
All right. Question here from the audience on do you have a current thoughts or target on Abra in the light of the recent election results?
I would say this: Argentina at the federal level has always been sort of a question mark, whether it was with Milei or with Kirchner. There's always been question marks at the federal level. I think with Abra, the concern right now would be if something were to happen with Milei, that would his and I'm drawing a blank on his tax reform for the mining companies. I forget what that's called. Whether that regime would be taken away because it's very meaningful to a company like Abra, whose construction window is basically in the next couple of years. And so if they got that taken away, it would impact the overall after-tax MPV if those tax incentives weren't going to be subscribed. And so I'll answer it like this is like we don't fully know what's going to happen yet. I would say on the provincial level, Salta has always been a very good place for mining companies to develop. Specifically with Abra, I was just there in April to visit Diblilos. On both sides of you, flanking Diblilos, are two lithium brine projects, one owned by POSCO. And POSCO is like a huge diversified conglomerate out of Korea. They are into steel, they're into a number of different aspects, but they've been sinking millions into this lithium brine project that's right beside Diblilos. what that's done is it's increased the infrastructure. It's increased what I would say the likelihood that Deblilos isn't going to have a ton of hurdles in front of it to be developed. And so, from that perspective, and considering how good of a project Deblilos is, it's in that top probably five, probably I would say top three primary silver projects owned by a junior. It's going to get taken out or it's going to be constructed at some point. So the likelihood of them receiving a market cap higher than what they are today, I think is likely. It's just how much. And so it's hard for me to give you a direct answer. I'm sort of skirting around it because I don't fully know yet. And it depends on a number of things and how they cascade. But what I would say is when you're at the top of the heap in terms of the project itself, you've got upside in terms of price to value. And I think Salta, no matter what happens at the federal level, Salta stays a place where miners can develop. I think that the prospects of Abra still remain very high. But of course, there's more question marks than there were before. And so it does give me pause in terms of how I frame or what my expectation is moving forward.
All right. We should be wrapping it up here shortly. We did talk about Abra. Are you able to, I don't know, maybe talk about your top picks or a nice a handful of companies that maybe aren't the 10 baggers, but the two baggers, like sort of good quality singles and doubles type of stories for to leave people to do some homework on?
Sure. Well, I'll give you one that's a good balance. It's got exploration and it's not it's like it's definitely an advanced explorer, but it's got some backing by some underlying value and some resource. The company is Group 11. The ticker is ZNG. I think that Bart is on the cusp of making a major discovery at Ballywire. They're a company I invested in. Super opportune timing just after PDAC. The share price has moved since, but I think what you're seeing is the early parts of a major discovery at Ballywire. I think the silver and copper component are something that should resonate with investors. I hope that Bart's and I hope the results obviously keep up with the silver and copper components, but I hope Bart really puts a lot of focus on that because I think that the market that we have moving forward is going to be, people are going to be looking for other silver and copper stories. And again, something like a project situated in Ireland, the connection with Glencore, the probability, considering their results and this trend that they've outlined, they stuck a couple holes, they've stepped out about a kilometer, 1.2 kilometers, hit some oxidized sulfides. I think they're on the cusp of again a major discovery, and it does need more work. But this is somewhere where you can benefit from the exploration, but also know that you have some backing from the resources that they have at a couple of their other projects and what I think they've already discovered. So I would say that's one you definitely want to look at. I think that Thesis Gold, the ticker TAU, again, if you're looking for a gold and silver company, the silver component is really usually missed with Thesis, but they've got a gold equivalent resource around 5 million ounces. They're located in the ultra hot Tootagon region of BC, where there's a couple of discoveries that I think are going to be the catalyst for consolidation. And outside of Amark's Aurora discovery, I think that Thesis sits right at that pillar of companies that need to be taken out in that area. You've got Centerra's Kemess just south of both the Discovery and Thesis property. And again, I think this region's going to be consolidated and it's going to be a gold company that does it. It won't be Freeport. And again, I think Thesis's valuation, the quality of the management team, the exploration results, which should be coming out in the next few weeks. I think everything aligns to a company that people should do their homework on and understand and make sure you meet or call Ewan, the CEO, and get a hold of him. He's an excellent CEO technically and from a financial standpoint, capital market standpoint, and a guy that I'm heavily invested in.
All right, Brian. Thank you. Really appreciate time. That was a lot of fun. I enjoyed chatting with you, learning about your perspectives and how you approach it. Thank you very much.
Thank you for having me.
All right. Cheers.